if you wanted to make the soft landing case, this is it perfectly. You couldn't have scripted it better.
The breadth data that we look at is consistent with a new bull phase.
We're actually in a bottoming, possibly for the month of August. The dollar reversed pretty sharply and yields turned down, and as both would be pretty big headwinds for stocks. The jobs number was pretty decent. I am optimistic that we're going to get a good CPI report next week. So that's a roadmap to seeing stocks do better next week.
You could maybe argue the tone is relatively optimistic given what we think used cars and rent is going to do in the coming weeks.
Yes, that's right. Used cars and housing are the two of the three biggest contributors to core inflation over the past year. But if it indeed is starting to glide path lower and used cars could fall another 30% and housing on the CPI could fall another 8 or 9, that would set up the stage for 3 or 4 months worth of negative contribution from those pieces. So I think core could print close to below 3%, maybe high 2s for several months. And that's why it would look pretty attractive.
I would imagine you would argue too that the sledding gets a little tougher from here.
It does. The market's up almost 20% year to date. So less bad news is discounted. I'm still pretty surprised how many of our institutional investor clients lean bearish. In the last 4 days, a lot of them have jumped on again to bet against stocks rising. There is some technical reasons to be a little bearish in August, but I think people are really quick to flip bearish here. That's not a sign of an ebullient market. It's a sign of people getting pulled in. And there's still $5.5 trillion of cash waiting to get pulled in.
What do you think yields told us today? We've had some high-profile announcements of short bets on the long end.
We know that there's a lot of political considerations and the potential for the Fed to cut rates next year, and the fact that rates are so low in the rest of the world that I think that those actually act as anchors to keep rates lower than we think they should be. And if 10-year yields keep falling, I mean, it's actually good for stocks.
B of A, title of their note, we see a soft landing. This is a firm that last fall was looking for negative payroll growth for much of the first half of this year. And then this afternoon, JP Morgan's Feroli, the end is not near, arguing that a recession in basically people who have been calling for a recession in 23 are running out of room, right?
A lot of economists underestimated the dynamic ability of companies to adjust quickly. Last year, the Fed told every company to get ready for higher rates, and companies prepared for that. So they weren't tripped up overbuilding or a bullwhip effect. And so we've had a pronounced slowdown, but then we don't have to have the contraction because there's no inventory to work off and no massive layoffs coming. When rates begin to cool and mortgage rates fall and inflation cools, it could be a pretty vigorous upcycle too.
Watching names that do miss on earnings and how they've been significantly punished and where that leads you in your playbook.
If we're in a market environment where stocks go up, but then when you miss, you fall big, it generally happens in 2 times. Either you're at the end cycle, you're about to go into a recession, or it's a market that has no oxygen. There's been almost no net inflows. Retail has taken $110 billion out of the stock market this year. Buybacks have slowed. Institutional investors are flipping bearish. So I think that means a narrow set of stocks have that support. That's really distanced and not connected to fundamentals. And I think if inflation's falling and fundamentals are turning, sponsorship of stocks is going to change. So I think that's more symptomatic of just low liquidity. Sometimes it's timing, because I know some folks have been like raising targets at the start of this month. I'm very wary about the month of August just because in my anecdotal experience, I felt like no one's ever made money in the month. But as we exit the year, if July is the last hike and financial conditions are easing and inflation's cooling, and then there's another expansion cycle starting, so the S&P could be far higher than 4,800.
We're in this zone where not only the rate of change, but also the level starts to work against equities in our, what we call our yield impact model. The good news is it's not disastrous. It's usually a consolidation. That consolidation's anywhere from a month to maybe 3 months. But I do think that we're going to visit this 4,300 level on the S&P and really just take a pause from some of the gains that we saw this summer. We have seen some of the sentiment, particularly in tech, some of the sentiment get a little frothy. So I think you have to cool that off a little bit. And usually when that froth starts to settle down, it takes more for people to become more comfortable buying things. I just think that there are enough pieces of the data that are out there that keep the bears invigorated, and it's still a pretty crowded camp on the bearish side, even with the returns that we've had in the S&P so far this year.
Looking at weeks, calendar weeks, with a lower high, lower low, and lower close on the S&P, one argument was that we had to go back to February. Does that make sense to you?
Yeah, that makes sense. It's been a pretty persistent, not very volatile, which actually we look at it as being good. When we have momentum and low volatility, that's usually a sign that you've got this perpetual motion machine in play. And we've had that, which is good news. And that's exactly why I think this is just a consolidation and a pause versus something that's more nefarious.
I know some of the landmines that you have on your radar, at least, are some of the banks, maybe regionals, looking a tad vulnerable. And I know you're watching credit spreads in the triple B space, right?
Yeah, those look good. It's remarkable. I think it's funny, if you would have asked me a year ago with the Fed and the aggressiveness of the Fed and an inverted yield curve, where would we be on credit spreads? I'd have said an 80% chance that they'd be above, say, 300 and almost 100% chance that they'd be above 200 basis points. And they're just not. So the availability of credit still remains, I think, a really important attribute of this market. It's something that the bears just haven't been able to really adjust to this entire rally. And I think until or unless we see a meaningful change in that liquidity dynamic, that the market is going to be in a relatively steady uptrend. And I think that's good news.
Years in which you're up 10 plus at the end of July. I think there's a few dozen examples, and almost every time you end the year higher, maybe not with a big further gains, but the years like 87 take the shine off of that analog. I wonder how you react to some of those historical trends and data.
It's pretty consistent with the things that we've seen. We went back and looked, and I'm not a big fan of the 20% rule calls a new bull market or a new bear market, but when you go back and look at that, 20% off of a low after you've had a bear market, you're better off saying that we're in a bull phase than still trying to fight the good fight as a bear. So most of that evidence is consistent. The breadth data that we look at is consistent with a new bull phase. It's not outstanding, but it's good enough. And I think it's better news for the remainder of 2023 than not. I think people will maybe get a little bit more emboldened on the bear side. I think some of the data is probably troughing, so you're going to see some inflation prints that aren't scary, but they certainly aren't going to look as good as they have over the last 6 months in our view. And I think that's going to give the bears a little bit of muscle and flex here. And then I think the market's just going to come back in and head to new highs at the end of the year. And that becomes a FOMO type of environment. And you get the seasonality. And if we get anything around the Fed actually pausing for an extended duration, I think it's off to the races.
7,000 net new jobs from July, though the unemployment rate falls to 3.5%.
My first thought was, this is maybe the most reinforcing jobs report you could have asked for if Goldilocks was if you wanted to make the soft landing case, this is it perfectly. You couldn't have scripted it better. You slightly underperformed the expectations on headline jobs. You get 2 downward revisions for the 2 prior months, and you get a downtick rather in the unemployment rate.
Right.
So you're basically looking at a situation where if you were spending the last 3 months converting from recession to soft landing, thank you for this. This is exactly what I need to feel better about that. And I can go another month or so feeling the same way.